All right, so welcome everybody, welcome. We're gonna get started here. All right, so we do that, and we do that, and we Control-Alt-Shift-H, we make it go away, and we're good. Okay, thank you for coming. We are at training number 7 out of 8, so we are almost done. We're almost done. We're almost ready to start helping people. I'm so excited to do that. Tonight, we're going to talk, we have a guest to talk to us about the low income tax clinic. We're going to talk about special circumstances, and then we're going to cover some more states until 7:30ish, or we can't bear the thought of another state because they go on and on. All right. So a little bit more, we're going to do the LITC overview. I'm going to do some general updates. We're also going to do an FSA demo with Elena. We're going to talk about special circumstances, right? When things go wrong, when things are not working properly, and then we'll go through some more states as we have time. We'll take a break somewhere in about an hour just to give ourselves a little bit of time. So, all right, with that, I'd like to introduce Soo-Young Lee to talk about the low-income tax clinic.
Hi, everyone. Thanks, Maria, for inviting me, by the way. My name is Soo-Young Lee. I usually go by Sue or Soo-Young, whichever sounds mouthful to you. I'm a third-year student at the University of Minnesota Law School next door. I'm also a certified student attorney in University of Minnesota Low-Income Tax Clinic. I am happy to be here to give you a very high-level overview about Low-Income Tax Clinic. So when you hear the term low-income tax clinic, you may question what that even is. I think that's a fair question to ask, so I'll just start from there. So clinic is basically a very small law firm inside a law school, which mostly runs by a student. So we offer free legal services to the community members, but those services are mostly offered by students who are getting supervised by actual attorneys. And we're the tax clinic, meaning we offer tax services there. Proudly speaking, we are one of the largest clinic in our law school. We have 12 student attorneys and 4 student directors. By the way, student directors are basically the people who are a student attorney. Do you want?
Elizabeth will get it.
Okay.
Thank you.
Student director are basically the person who was a student attorney before, like a year before, they came back to the clinic to supervise student attorneys. And then we get general supervision from 2 amazing professional attorneys, picture up here, Professor Smith and our tax clinic fellow, Hannah Stephan. As I previously mentioned, we're a low-income tax clinic. It's not just a name. It actually shows who we can represent. We get federal funding from the IRS, and that funding is conditioned under our scope of representation. We are supposed to limit our scope of representation mostly into low-income taxpayers, and actually IRS defines that based on the income cap, which they named as poverty cap. Basically speaking, if the client's current income, household income, is lower than the cap, we may be able to represent that person. If the person goes over the cap, we may not be able to represent that person. There's like a really narrow exception where we can represent the people above the cap, but that's basically the discretion of the supervising attorneys. And what we do offer tax services, but we don't offer all kinds of tax services, sadly. We offer 3 tax services in general. One is we advise clients in tax issues such as audit of tax returns, filing and collection, basically everything that comes before the court. So if someone receives a scary letter from the IRS, we usually help them to resolve the issue. If the client decides to go to the court, or if they're already in the court, we also help clients to raise their voice before the court by representing them in tax court or federal district or wherever they are. Not often at top 2, we also do some bigger policy projects like raising the voice of low-income taxpayers before the government, could be federal or could be Minnesota Department of Revenue. As I said, we don't offer all kinds of tax services. Actually, we cannot. by a bunch of different reasons. For example, we don't file taxes. Precisely speaking, we do file taxes if that's the best way to resolve the issue, but we don't do like routine tax filing. It's actually what you guys can help for, not me. We are a federal low-income tax clinic, meaning we don't have a capacity to represent clients for state-only tax issues. We can do when the state tax issue kind of tied into a federal tax issues, which happens pretty often in case of federal income tax board. But if clients have some kind of state property tax issues, we cannot represent them. Speaking of the property tax, we're the income tax clinic, meaning we have no capacity to represent clients who's having a property tax issues or non-income tax issues. Speaking of that, as you can see, residency status is not a matter for our scope of representation, regardless of whether this client is resident or non-resident for tax purpose. We can represent this person as long as they fall under our scope of representation. So our client's issue could be split into two, which is very well illustrated in those three scenarios, which I'm not going to read in full to save our time. But the first issue we generally get is when the client should not owe that tax, like there's a glitch in withholding tax assessment, or if there's a W-2 that should not exist, which actually happens because those assessment and review process often happens by computer, and computer makes mistakes. Another issues we face really often is when the client owes the tax, they consent that, but they cannot pay, which is illustrated in scenario 3. And I'm just going to give you a more elaborate example of scenario 3 because we get this kind of case really often, and 2, we have a general strategy. And so I think this is a good example to show how do we work and how do we move forward with the client's issues. So in short, this person filed a tax, missed some of the income because they didn't know they had to file. IRS sent a letter to them saying that, hey, you owe the tax, you didn't report this, you should pay more tax. And this person kind of ignored all the letters until seeing the letter with the name levy. By the way, that's not a good strategy, but this somewhat happened. So after this person see the letter with the term levy, they got frightened and came to the clinic for help. By the way, this person consents with the tax liability figuring because they knew that they actually tripped off. When we see this kind of issues, we usually propose or move forward with one of 3 movements. By the way, you don't really have to know this. This is more like a tax clinic job, but it's just good to be aware if you see the client with the similar issues. Basically speaking, we usually start from offering compromise, which is basically asking the IRS that, hey, IRS, this person cannot pay the tax. Could you just wipe out some of the tax liability? So since this one actually decreases tax liability depending on the client's ability to pay, we usually start from there. And then if the offering compromise doesn't work, we usually move to requesting the IRS to halt the collection action, which you usually call as CNC status, currently not collectible. Basically asking IRS that, hey, IRS, please stop your collection action because this person really cannot pay. If that doesn't work, we usually move on to installment agreement, also called a payment plan. We just ask IRS that, hey, IRS, I really want to pay, but we cannot pay in full, so let's split this payment into months-long period, and I'll just pay in full in like year 3. This is since the OIC kind of really affects the tax liability, that's usually the point we start with. But just a note that in case of non-resident taxpayer or the resident taxpayer who's not a citizen, this may not be the hierarchy we follow because their residential status is unstable and especially if they're seeking for like permanent residency, like green card, it may be safer for them to just comply with the payment duty rather than asking some grace to the government. None of the IRS nor DHS says they're going to penalize the applicant if they have a CSC status or offering compromise. But as you know, immigration process is a full black box. So we just try to stay conservative on that point and try to suggest the client that maybe could be better for your immigration process just to pay the tax instead of doing some like CNC status or offering compromise. You are listening all of this because you may need to reach out to the tax clinic if you see a client with some legal issues, and your question may be, well, how should I decide whether I should reach out to clinic or not? I think it really depends on case, but I think those questions are something good to ask to determine whether you should transfer the case to the clinic. I think the first question would be all the administrative questions, like is this person falls below the poverty cap, or is this the issue of a filing? But I think the most critical question is whether this person have received any letter from the IRS. Why that matter? Because some of the letter from the IRS have some legal value that gives IRS some ability to make some movement. I think the two most prominent examples are statutory notice of deficiencies and notice of intent to levy with the intent to hearing, long name. I think the second one is really critical because that gives the IRS to actually levy on the property, which is kind of scary. So how to reach out to us? If you're not in Minnesota, we may not be able to help your client out because of jurisdictional issue, but I will touch on that pretty soon. But if you're in Minnesota, we can help you. This is how you reach out to our clinic. You can call, email, or you can also submit an online form, which is connected to the QR code, which if you're interested, if after you reach out to clinic, the admin people will do some brief intake interview to figure out which clinic should take the case, in our case, tax clinic. And after the supervising authority, Professor Smith, takes the case, he will allocate the case to the student attorneys, and the student attorney will reach out to the person to get some preliminary interview to figure out whether we can represent this person. And if we decide to represent, we're on the board. If you're not in Minnesota, good news is we are not the only tax clinic in the United States. The tax clinic is actually spread nationwide. You can find your neighbor tax clinic either in the LITC website runs by the IRS. They actually have some search function there. You can also check the IRS publication, which is hyperlinked there. So you can click it later after you get the slide. That publication has a full chart showing the list of the LITC nationwide. This is all I got for the high-level overview. If you have any questions about the clinic, I'm happy to answer, but otherwise, thank you for listening.
So I'll throw in a couple of words. Does anybody have any questions online before I start talking too? All right, so I think that the main thing to know, right, is that so we here as an IRS FIDA clinic, we are going to help people prepare their returns, right? And we're going to do our very best to make sure that they're right when they get sent off to the IRS and to the State Department of Revenue. Sometimes things happen, right? Sometimes people make a mistake. Honestly, they make a wrong number entry, a new form shows up. When something happens and it goes wrong and they get a letter from the IRS, right? That's when we're going to turn to our friends at the LITC and say, here, you are good at this stuff. You take a look at all of that, right? If somebody comes to us and they say, oh, I think I made a mistake. Can you help me fix it on the return? And they haven't gotten a letter from the IRS, right? They just were like looking at their return for this year, like, oh, yeah, if that's right, then that probably means that last year was wrong. That would be an amended return. And if the IRS isn't involved yet, we can still help with that. Or if somebody comes to us and says, yeah, you know, actually, I haven't filed ever. Can you help me with all of those earlier years? we can help with that piece as well. So if it's filing a return, generally we can help with it. But once it comes to the point where they get that letter from the IRS, then we're going to turn them over to somebody that's going to provide some additional support for that situation. I will also say, so back in 4 years ago, back in pandemic days, right, there were a bunch of payments that went out to people, pandemic money, right? They gave, oh, here's $1,900, here's whatever. In December of 2024, the IRS attempted to say, hey, here are all of these people that were supposed to get this $1,400 and they didn't ever get it. So we're going to just throw that money out there to them. Except that their systems made mistakes about who got that money. And a lot of international students that were non-residents, they got those $1,400 checks when they were not supposed to. Some of them figured that out, tried to send it back. Maybe the IRS sent it back again and they went like a little dance for a little while. But eventually, kind of this past spring and summer, the IRS sort of got their systems in line to figure out, hey, actually, we kind of shouldn't have sent that money back. The IRS systems are generally very, very slow to work. So here we are a year plus later, those people that got that check that didn't really pay attention or didn't realize, didn't send that money back, they are starting to get some of those scary letters. So when we see somebody at the tax clinic, you can always ask them, hey, have you ever gotten a letter from the IRS? We've got some free resources that we can refer you to help with that kind of situation because we're sending people there, right? I won't say that it's like thousands or hundreds, but a dozen, 2 dozen, something in that kind of a range. So it's enough people that we want to make sure that everybody is aware of the situation and kind of prepared with what to do. And this is happening, this is not like a Minnesota thing. This is happening all across the US to international students everywhere. So, all right. Thank you so much for coming. I appreciate it. All right. Please help yourself before you head out if you would like.
Yep, thank you.
All right. Okay, so let's move on to volunteer update. This graph looks so much better. Thank you everyone so much that has signed up. You can see that the number down at 0 is a lot smaller. There are still a few of you, I will pester you, but we've definitely made really good progress in getting people signed up for events. So I really, really appreciate that. It is too busy to look at other than to say, oh, there's a lot more dark blue than there was last week, which is great, right? That's everybody signing up for the tax clinics. So I would say some of our, like more of our remote events are starting to get full, but we still have quite a few openings. Maybe they're not like the most popular days and times anymore. Our in-person events generally all still have people that we can take. Those we have can handle a very large group of both volunteers and clients. I'm going to ask one more time, road trip, please sign up. We've got the locations and the dates for where we're going posted on the calendar where you're signing up. So we're going to Duluth for the long road trip. They always take really good care of us. We get some really good food out of it. We're going down to Mankato. We're going to the College of St. Ben's, St. John's, and we're going to Riverland Community College, which is a new one for us down southern Minnesota somewhere. I forget exactly what the name of the town is. So hope that you guys can join us for some of those. I won't say that's the end of my pestering on tax clinic signups, but that's mostly the end because I'm going to switch and start doing more nagging on Moodle, right? I've kind of said this a few times. I'm going to say it again. Thank you again, Soo Young. To be a volunteer, right, you have to do more than just pass the IRS tests, right? There's a lot more than just being able to answer a few questions. You need to learn the federal tax law, that is true, but you also need to learn state tax law. You need to learn the TaxSlayer software. You need to learn the personalized guide. You've got to demonstrate that you know all of this stuff before you volunteer at the tax clinics. So, as I look at Moodle, so we have about 45 or so volunteers that have passed the IRS test, which is fantastic. Of those, we've got about 8 that are mostly caught up with everything. Another 12 that have kind of made some progress in the spring materials, right? You got through the test, you've kind of done something at least since we came back here this spring, but like about half of you haven't really done much of anything in Moodle since you got your tests in. So we've got this week, we've got next week, and then we're going to be moving into tax events. So we want to try to, if you're going to volunteer with us, we want you to get through that, right? Passing the IRS test, it's like, I think it's the hardest part, but there's still more to learn, more to do, right? There are only bad outcomes if you go into a tax clinic and you're not prepared, right? Somebody asks you a question, either you can't answer it and you feel, embarrassed or uncomfortable, or you answer it incorrectly, right? And then we send somebody off to file a return incorrectly. And a year and a half down the road, they're talking to Sue Young because they've got a letter from the IRS. So if we need to cut back event capacity to what 20-ish volunteers can support, the next week or two is the time to do it. But I would much rather try to help everybody succeed, right? I want you to succeed. I'm here to help you succeed. But unfortunately, I cannot do it for you. So please engage. There will be a few email reminders as well to do that. All right. Yes, the spring modules, I think they start, 11 is the tax clinic sign up. So 12, 13, 14, maybe 15 are the spring modules. All right. Member update really quick, right? So we launched a week and a day ago. Things are progressing. Last time we met, there were like 100, maybe 150 people that had signed up as members. Now we're in the 600, something like that. So this is pretty typical of where we usually are right now. As time goes on, more people will renew their membership, so that starting origin point of the blue line will go up, and then we'll have new people join as members, and so the line will kind of diverge from the prior lines. This is all kind of the way that I would say, expect it to look like. Tax clinics, there are definitely some people signing up, right? We've got our first office hours on Friday. That's basically full. Next one's starting to fill up as well. The first in-person events are starting to fill up also. So that is really good to see. For the NRVTAP volunteers, if you signed up for the Volunteer Readiness Check Pilot, this is kind of where we're at in terms of getting clients for you to work on. So we still have a couple of weeks, so it's not like the end of the world, but we may need to use a few virtual clients if we don't get enough in-person people signing up. But I would expect the international student newsletters just went out with our NRVTAP information on them, so I think we'll start to get more people signing up for these in the next week. All right. Any questions on that before we move on? All right. So a brief review from last week. So we have people that we will be supporting with state income tax returns from 11 states: Minnesota, Pennsylvania, North Carolina, California, Maryland, Wisconsin, Kansas, New York, Alabama, Arkansas, and Iowa. Everybody's going to learn Minnesota. That's 50% of the clients that we see. So anybody that's doing a remote event, anybody that's volunteering with us needs to know Minnesota. Everybody's going to learn 2 of the 3 big ones: Pennsylvania, Maryland, New York, and then 1 or more if you want it, but at least 1 of the other kind of small states. And then again, right, generally the software does a pretty good job of preparing the state returns, but sometimes we need to make adjustments. Almost always what they throw up on that front screen about residency is not going to be correct or accurate for our clients. So we give instructions in that personalized guide. Don't say full year resident, don't say non-resident, say this or say that, so that you can get that actual state return done correctly. All right, here's kind of what people chose, at least the people that responded, the 29 of 44 that have responded. Pennsylvania was the big winner on the main states, and then New York and Maryland. California was the big winner for the other states. So lots of people want to know how to do California taxes and go live somewhere warm at this point in the winter. I don't blame them. So if you made a request before we finished or before the survey was done, I am honoring that. You will get assigned the states that you want. If you only picked one of the big ones, I will give you an extra one. So happy for the bonus there for you. But otherwise, you're going to get what you want. And then everybody else who didn't finish the survey in time, they will get assigned, not California. They'll get assigned the other states. So, all right. A couple of words really quickly on states. Minnesota. So if you're doing a Minnesota return, one of the key things to know is there is a little checkbox on that says if this is your first time filing, or if you have moved since the last time you filed a Minnesota return, put an X in the box for new address. That's in the personalized guide, but it's really easy to miss if you haven't done it. And there's also a change where you have to put in the county of where you're living. Generally, this is, I think, due to the renter's credit is why they have people do that now. I don't really know otherwise. But you can just look it up on Google with their address if you don't have it, or the people can look it up themselves. So that's kind of what that is where that's coming from. Also a note on some of the states, when we have treaty exempt income, we're going to have to turn around and make it taxable, right? There's a bunch of states that don't honor tax treaties. We ended up with a lot of them, right? Pennsylvania, California, Maryland, Arkansas. I feel like there's another one or two. Anyway, so when we have a situation like that, right? If somebody is reporting treaty exempt wages, we're going to have to make sure that those treaty exempt wages get taxed in that state. So there are information, and there will be information in the personalized guide about how do you go in. Usually it's an income subject to tax, other income, and then you can add it in as like other income that you have to tax. So just so that you guys are aware of that kind of nuance to be looking out for it when you do tax returns. All right, so with that, let's take a pause away from the states for a little bit and talk about special circumstances. So by now, you should realize, right, unfortunately, TaxSlayer is maybe not the most user-friendly for non-residents, right? There are lots and lots of little fiddly places where we have to enter stuff onto the Schedule OI, into the 8843. We have to enter information multiple times, right? If you enter a W-2, you just say, oh, there's the income, there's the tax withheld, and it like puts it in all of the right places. But if you're entering a 1042-S for scholarship income or wage income, you're going to have to like enter the 1042-S, and then you're going to have to do something else again. It's kind of frustrating and annoying, but that's the way it goes. We also have situations where our clients' income documents don't match their situation, right? So we can think of this in two ways, right? Number one, people can get scholarships where they don't have an income document for that scholarship. Other times, people will have treaty exempt income that's not reported as treaty exempt income, right? This is the Sergio example. All of his wages were on a W-2, reporting it as being taxable wages, even though he has a treaty benefit for wage income. When that happens, we need to be able to do some fixing in TaxSlayer. All right, so all of our guides have the instructions for how to make those adjusting entries, right? They also will tell you about things that we don't have time to do a lot of extensive training on, like investment income, right? If you think that 8 weeks is already enough, imagine trying to train on all of this stuff. We would be here for another month at least. So this is why we tell all of our clients to prepare the guides and use those guides to prepare their returns. This is why we want you to be very familiar with the personalized guide, right? Our clients, when they come into the tax clinic, they're going to have questions about what the guide says. They're going to get lost halfway through it and say, oh, well, my screen doesn't match my guide anymore. Like, where do I go? I don't even know what to do. So you need to help them figure out how to get back on track. The guides are also a really quick and easy way to kind of answer a lot of your questions or challenges. So for example, right? Somebody that's been dabbling in the stock market comes in and they have all of their stock transactions on Schedule D. That's not where they go. They go on Schedule NEC, right? Their investment income. It's not effectively connected to a US trade or business. We can just say, hey, it looks like you've got your stock transactions entered like you were a resident, but you're a non-resident. So we need to delete them there. And then your personalized guide will walk through how to enter them, right? And with that, you can spend 30 seconds getting them straightened out, getting them started in the guide, and then you can go help somebody else while they're doing all of the keystrokes to get everything entered. Once they're done, you can come back and review. You're good to go. All right, so let's talk about a few of the common situations that we see. Big one, scholarship or fellowship not reported on a 1042-S. This can happen relatively frequently for, I would describe it as like either postdoctoral students, or not really students anymore, postdoctoral individuals or PhD students where they have income that's being provided by a grant outside of the university. And so the university doesn't provide any documentation and they've got nothing. So the IRS generally requires organizations to report income that's paid to individuals, but it does not generally require people that provide, or organizations that provide scholarships or fellowships to report those. That's basically considered the responsibility of the lucky person who ever got that scholarship or fellowship. Even though we get all kinds of income documents from other sources, unfortunately, this is one area where it's not reliable that we're always going to get an income document for it. The university has a whole thing on their web pages about some people will get those, some people will not get those. Generally, when we see somebody in this situation, what they're going to do is they're going to look at their final end of year pay stub, and that's going to show them the amount of their fellowship income for the year, and we can use that information on their tax return. It's not ideal, but that's the only thing that we've got that documents how much they were paid during the course of the year. I will say that I think the University of Minnesota is probably the worst on this. I don't think that other schools are quite as bad about this, but we do see a decent amount of those here at the U of M. All right. So when we think about scholarship and fellowship income, what are the things that we can do with it, right? How can we treat it from a tax perspective? First one, right? The best one. We can exclude it. If it's spent on qualified education expenses like tuition, required books, or fees, it's not taxable income. It doesn't have to get reported on a tax return. It's great, right? Wipe our hands, we're done with it. Next best, it's treaty exempt, right? We love this. This is Harold's situation, right? They give him all this money. He doesn't have to pay anything, and he gets the treaty. It doesn't matter what he spends that money on. If he was from one of the CIS, the Commonwealth of Independent States, the former Russian republics, there is a different treaty benefit. They get a $10,000 maximum every year. And they can only spend it on ordinary living expenses, rent, food, that kind of thing. Everybody else, all the money in the world, spring break to Miami, spring break to Hawaii, whatever you want to do, it's all good. They don't have to pay any tax on it. Everybody else, including all poor residents in the world here, we all have to pay tax on it all. All right, so excludable, treaty exempt, or taxable. And then how we report it on the tax return is going to be based on the tax treatment, right? If it is a qualified scholarship, we're not going to report it, right? There's nothing to put on the return. You don't have to include anything. This includes things like tuition waivers, like somebody's, I'm charged non-resident tax tuition, but I get a waiver for the non-resident piece. That's a qualified scholarship. We don't have to report that. Many other scholarships and fellowships that can be shown on people's student account statements, those would meet those requirements. If a student actually got the money and then they spent it on a qualified education expense, we would need to report it as income and then report it as a qualified education expense to subtract it. So we would have to do the netting out there. If it's treaty exempt, very easy, right? We're going to only report it on Schedule OI and that table L down at the bottom, and then the 1040 NR line 1K. It never goes into any math calculations on the forms, just kind of off to the side there. And then the final one, taxable income, that gets sent on to Schedule 1, line item 8R. And if there are any qualified education expenses, you can subtract them on line item 8Z, which is kind of the other line. You can say qualified education expense, And as long as you don't put that S in there, there's enough character limit that you can fit it all in. All right, so that is one big piece where we see where there's fixing that needs to be done when somebody has a scholarship or fellowship, if it's taxable and they don't have any documentation. The next time we see a lot of this is when treaty benefits don't match income documents, right? And there are kind of three sort of categories of this situation. Number one, you can receive a W-2 for some wages and a 1042-S for some wages, and the total of both of those is less than your treaty benefits. This can happen after, usually for J1 teachers, researchers, professors, things like that, where they have an unlimited treaty benefit, right? No matter how much money they earn as a researcher, they don't have to pay any tax on it, right? It's a great deal. If they are not very well organized when they first start working, they won't have signed any paperwork with the university to claim that treaty. And so they'll have a paycheck or two that gets reported on a W-2, and then everything else gets reported on the 1042-S. So that's one time where you have some reported as taxable, some reported as treaty exempt. You have to move everything over to the treaty exempt bucket. The second one is kind of the opposite, where you have only a W-2 for wages. You're eligible for a treaty benefit, but you didn't get a 1042-S, right? Either you didn't go in and fill paperwork out, or maybe you worked at an internship at another company and they don't do that kind of thing. That's totally fine, right? You can still claim your treaty, but we now have to just move some of your wages from the taxable bucket over to the treaty exempt bucket. And then the final situation that we sometimes see is that you can receive two 1042-S's. And together they total more than your treaty benefit, right? This is usually for somebody that transfers college. Student from China, they get a $5,000 treaty benefit. They earned $4,000 at their first school. They earned $3,000 at their second school. That's $7,000. And they get $5,000 treaty benefit. They don't get like $5,000 from each school. So they have now $7,000 reported as treaty exempt. They have to move some of that back into the taxable bucket to make $2,000 be taxable wages. So that last one is not very common, but it does, like all of these happen. Number 2 happens a lot. Number 1 happens quite a lot too. Number 3 doesn't happen very often, but it does happen sometimes. All right, so some of you have probably already found this magic box in TaxSlayer. And if you remember Sergio, right, we had $8,000 of wages. We had to subtract $5,000 on that line 1A so that we only reported $3,000 as being taxable wages. The magic box to enter that is in the Schedule OI general information. It's in the general, not the treaty exempt income. If you scroll down to the bottom, it says wage exempt by a treaty. This is not the table L information here. This is this place to put that subtraction number where it says, okay, I have wages of 8,000. I'm going to subtract 5,000 so that I only have to pay tax on 3,000. You can also do this the other way. If you put a negative number in there, now you will generate additional wage income that gets reported on the 1040 NR. So this is an adjustment for wage income is the way it works. All right. Let's talk about working in multiple states. So this is pretty common for international students, right? They go to school, they have a job somewhere, they have an internship in another state, they come back, and now they have 2 state returns that they need to prepare. The general state tax residency, when we prepare returns, right? Pennsylvania and California are going to be non-residents. Everybody else, it really depends, right? It depends on mostly how long they've been there. It can also depend on whether they had a house or an apartment or anything like that. The thing to know about TaxSlayer is when you are a resident of a state, it's really good about making sure that all of your income flows from the federal return down to that state return. When you're a non-resident or a part-year resident, things don't necessarily automatically flow the way we would like them to. Generally, wages are going to flow pretty well if you've said, this is my W-2 and this is the W-2, the state boxes down at the bottom. You say, okay, this W-2 was from California and this one was from, Washington. It's going to figure out and put those in the right places or not onto the right places or the wrong places in the California return. There wouldn't be a Washington return. Sometimes, though, particularly for scholarships and fellowships, because there's not an income document that we're entering, because it doesn't have anything that like triggers, hey, this money was from Minnesota or this money was from North Carolina, it is not going to flow properly, and you need to make adjustments to make sure that you add that income on your state tax return as well. All right. Okay. So the personalized guide, there is a link to create a personalized guide in the, I think it is the module 12 or 13. I don't remember which number it is at this point, but there is a link to create a personalized guide there. And it is personalized. So you're going to go through, you're going to answer the questions, what is your visa? What are your days of entry and days of exit? What are your income documents? Where were you physically at? All of that stuff. And then it's going to give you the specific instructions about entering everything. It is still 2024 right now. Fair notice, 2025 should hopefully go up this weekend. But that's where you can find the guide that tells you how to enter everything. So perfect. That's great. Okay. One other thing to know on those guides. So we tell everybody when you're starting to start as a part-year resident. That is 100% not true, right? They're not going to, like almost nobody's going to be a part-year resident. But we say that because if they say resident, it's going to automatically start the state resident return. And it's going to create a resident return that may not be correct. And so then we have to try to get them back to delete it and to restart. If we say, click part-year resident here, it just won't start any state returns. And then when they get to that state section, we can tell them, you're a resident, you're a non-resident, you are actually really a part-year resident. So that's why we do that when you see that personalized guide. If you ever get any questions, it's because that gives them the entry into the screen where they can choose their residency rather than saying, oh, your address is here in New York. You must be a New York resident, which they're not going to be. Okay. Moving on. All right. So if somebody needs an adjustment, this is the way it kind of looks. So when you're entering your information into the personalized guide, there's a point where you say, hey, what states did you live in? Did you get any income in those states? Remember, a lot of our states, the residency for them depends on, were you physically present in that state? So here's an example. I was in Minnesota. I was in California. Yes, I got income from both of those. Then we have to look at, okay, well, where were you physically during the year, right? Remember, Minnesota has that horrible 183 days plus the rent, don't occupy, maintain thing. So let's start with days. How many days were you here? How many days were you there? We can do the math. We can say, all right, if that's enough, we can just tell them automatically, right? You're a non-resident. If somebody comes in from Pennsylvania, they're never going to see this screen because it doesn't matter. We know they're a non-resident automatically. If they're from Washington, they're never going to see the screen because there's no state return. We don't have to worry about it at all. But if it matters, they're going to see a screen that looks like this to say, hey, where were you physically? We will get questions about, hey, do I have to put every, I went on a weekend trip to Chicago. Do I really have to put a weekend trip to Chicago? Well, maybe yes, sort of. I don't know, right? If we think about Minnesota residency, 183 days. So if you were close to that 183 days, then those 2 or 3 days that you were gone might make a big difference. If you were here the entire year, but then you were just gone for one weekend or 1 week for spring break, then no, that won't really make a difference, right? So 100% absolutely the days have to be good if you were earning any income in the other states. Otherwise, we're going to say it depends a little bit on how long you were there in the other state and how long you've been here. The safest answer is, I'm sorry, it totally kind of stinks, but Minnesota residency is based on you physically being in Minnesota or one of the other states. We kind of need to know when you were here and when you weren't here. If you are in Minnesota, then you're going to have some periods of time that you were here. We're going to ask about that. Did you rent, own, occupy, or maintain an abode? Yes for the whole visit. Yes for part of the visit. No for none of the visits. And note that, right, that you can still have a Minnesota apartment even if you're not physically present here in Minnesota, because that does, of course, happen. And then we'll do some math to say, hey, congratulations, you're a Minnesota part-year resident for the year. Well done. All right. Did I go the wrong way? All right. If they have a scholarship or fellowship, and it turns out that they are a part-year resident or a non-resident, we're going to give them some extra instructions about how to walk through that adjustment to make sure your University of North Carolina, Asheville scholarship now gets shown on your North Carolina tax return. And I don't have any of those slides here. I thought I did. Never mind. They're in the personalized guide. Guess what? You probably will get to do a scenario where you get to make an adjustment like that. All right. Any questions on those adjustments before we go on? All right. So this is like the nuance of TaxSlayer, right? We've done the basics of TaxSlayer. Here's all of the like fixing where students may not get it right on their own, right? If they're following the guide, it'll probably be good, but if they get kind of lost, these are the places that they will struggle as well. So we're going to make sure you get a chance to practice those so you know how to unstruggle them. All right. Any questions? Okay. All right, let's move on. We're going to talk about the Minnesota property tax refund. Oh, the Minnesota property tax refund. All right, nothing generates as much excitement or despair among Minnesota taxpayers as the property tax refund. Unfortunately, many of our Minnesota filers have heard about this. Oh, yes, I hear you get money back from the rent that you pay when you file your taxes. Unfortunately, the vast majority of our clients do not get a refund for this. Only about 25% or less are eligible for a refund, and less than 50% of those are going to actually qualify for the refund. So it is not very many people that actually get this. And yes, there is a penalty for claiming this refund when you are not supposed to, right? That is filing a fraudulent tax return, and very much not so good. Last year, Minnesota split this up between two different forms. Before it was always, if you own a home or you rent, you can fill out the same forms and get a refund. They split it up and they put the renting portion onto the regular Minnesota tax return, and they left the people that own a house or a condo, the homestead credit, that is still on the same kind of property tax refund forms. All right, there are some requirements for both of these. For both of them, you must be either a full year or a part year Minnesota resident, which means if you came for the first time in the fall, no matter where you lived or how much money you paid in rent, you weren't here long enough and you won't get a refund for that calendar year. Next year, you can file based on next year's rent that you pay or next year's property taxes that you pay, but not that first year. You must live in a unit which is considered an abode, which is their like fancy legal way of saying that it has sleeping, bathing, and cooking facilities. It must have been subject to property taxes, right? A lot of university housing is owned by the university. They don't pay property taxes, or it can be owned by a nonprofit co-op and they don't have to pay property taxes too. So if nobody pays property taxes, then nobody gets a refund on any property taxes. The good news is it's available for any filing status. It doesn't matter if you're single or married filing separately. All that matters is that you're living there, you're a Minnesota resident, and you're paying rent. All right, kind of already talked about that. Let's do this. The next big one, and this is the one that really gets, I would say, 70% of the people, which is that you cannot be a dependent for the property tax purposes. So, and this is the IRS definition of either a qualifying child or a qualifying relative. It doesn't matter if somebody's actually claimed as a dependent or not. What matters is that they meet these tests. So the first one is basically that they are an individual with a parent or an adopted parent. They are either under age 19 or above age 19 or under age 19 or between 19 and 24. So that is the primary range that our clients are at, right? They're college students. They come here. They've just graduated high school. So 18 to 22, 3, 4, something like that is our common range. If they are in that range bracket where they are under age 24 and a full-time student, they must have provided over half of their own support. If they provide less than half of their own support, they don't meet, or they meet these tests to be a qualifying relative or qualifying child. My apologies. So under age 24, provide over half of their own support. If they are over age 24, then they just have to have more than $5,200 of income. Typically what we see is that most undergraduate students are in that age bracket to be under 24. Very few of them provide more than half of their own support, and they're not eligible. Individuals that are here for an advanced degree, master's, PhD, often they are above that age limit. And so the amount of income that they need is much smaller, and they often will be eligible. All right. Let's talk a little bit about the renter's credit in particular. So basically, the eligibility didn't change, but the process has changed. Now it is a part of the standard Minnesota return. There's also some really great news in that the calculation for the refund changed. Previously, you had to include all of your treaty exempt, non-taxable income for the renter's credit. And so that would be huge, right? If you imagine somebody that's coming to school and they have a scholarship that pays for all of their tuition, right? That's a pretty darn big number. They have a treaty exemption for wages or for a scholarship that pays for room and board. They may have no real money that they see, but they have on paper, right? They're getting a lot of income that they don't have to pay tax on. That used to be calculated in here. It's no longer calculated for the renter's refund. So that is great. That is for 2024, 2025 now, of course, and going forward. Anybody that would be old, they would have to use the old rules. Landlords are now required to file their certificates of rent paid electronically. Used to be that they were kind of typed or maybe even handwritten. Now they all have an electronic control number. This is a good matching, right? The Minnesota Department of Revenue says, oh, your landlord says that this was your rent, but you say this was your rent. So they are making sure that everything is getting reported appropriately. I think a little bit for the property tax refund, but also I think lots for making sure that landlords are reporting their rental income for their properties appropriately as well. So if somebody can't get a CRP from their landlord, then the Minnesota Department of Revenue can help them with that. They basically are kind of reporting them to the Minnesota Department of Revenue. They take it very seriously because they want to make sure that people get these credits that they're supposed to. They can submit this rent paid affidavit and they will basically make the paperwork work. If somebody has a CRP that it doesn't have that little ECN number, they can go ahead and submit electronically. TaxSlayer will let them send it in, but their refund is probably going to get delayed while Minnesota Department of Revenue tries to figure out if that rent was real and who didn't report it. All right, this is what one of those CRP forms look like. They don't publish them anymore. It's only online for submitting, so I can't like create new copies anymore. But the ECN number is in that upper right-hand corner of where it goes. So this is what it would look like. And it has basically information about who it was, the unit they were in, how much rent they paid, who owns the property, who's signing that they're the manager for this. All right. There can be a few situations. If more than one adult lives in the rental unit, then the rent is split equally. Maybe somebody's paying more because they've got the better room, but for the CRP purposes, 50-50. If you are married to the person that you're living with, and using the married filing separate status, you can add that person's CRP to your tax return when you file. It used to be that if your income was less than rent paid, you had to make an additional statement. That doesn't seem to be the case anymore. So that is also some really good news about that. All right. A couple of words on that dependent evaluation. So when somebody comes in and they say, oh, hey, I have my CRP. Am I going to be eligible for this renter's credit thing? I hear you can get some big money back. The first thing that we're going to ask is, have they done a dependency evaluation to figure out if they're a dependent or not? How old are they, right? Are they under that 24 or are they over that 24? We will have these little worksheets there at the tax clinics we can hand out. But as we look at it, we basically say, all right, let's just estimate really quickly, pretty darn close, but it doesn't have to be to the dollar. What are your expenses? What is your income, right? If we look at the U of M, tuition, something on the order of $42,000 a year. Rent is going to be from the CRP, whatever that number is. Food, clothing, a little bit of fun, right? Somewhere in that $5,000 to $10,000 a year range, easy. A full meal plan at the semester or per semester is $3,000, just to kind of have a reference point there, right? So we are easily looking at $50,000 plus, right, to be here for a year. Let's look at our income, right? What do our W-2s say? What do 1042Ss say? Is there any other money coming in? Where is that money coming from, right? If it's coming from family members, which is wonderful, it's great. That's fantastic that they have family that's going to support them. But that means that they are dependent on that family. And it doesn't matter if like the family put it into their bank account and then they took the money from their bank account and paid it to rent. Like, where did that money come into that bank account? Who put that money into their bank account, right? Was it a company, right? Did they have this fabulous internship out in wherever? We get people that do that, right? They have a great internship. They make more than half. They're super great. They're set. But for a lot of people, this is going to stop them. And you should always ask these questions first before you get into the details of the form, because you can head off a lot of work by just making sure that they're eligible before you go any further. All right. We always want to do that because we don't want them to get one of those letters from Mindor saying, hey, we calculated that actually you were not eligible for this. So it's already 6:30. I'm going to skip these. If you guys want to, when you go back through the slides, you can look at, right, we've got some of our examples. Let's talk about Lisa, right? We'll do Lisa really quick here. I'll do Lisa. So she's an F1 student from China. She came here in August of 2023. She lived off campus in an apartment the entire year. On her CRP, it says that her rent is $7,200. She worked on campus. She got a W-2 for wages of $8,400, a 1042S for $5,000, right? So her Minnesota residency is going to be a full year resident, right? She was here in Minnesota for more than 183 days. She paid rent all year, so she's a full year resident. However, right, I can look at these numbers and I'm going to say like 99.9% of the time, right, she is going to be a dependent. Her rent was $7,200 and her total income was $13,400, right? So where did all of the money to pay for tuition come from, right? Where did the money for food come from? Where did all of the rest of it come from, right? That would be the question that we would ask, and the thing to remember, right, is that we're trying to, although we will be delivering perhaps a little bit of bad news to these clients, right? we are really trying to help them to make sure that they are filing a correct and accurate return and that they don't get in trouble. The Minnesota property tax in particular, right? That is not something that the low income tax clinic will help with because that is only a Minnesota thing. There's nothing on the federal return that touches it. So if they mess this one up, they don't have those same free legal resources to get assistance. All right, we're going to skip those. For the renter's credit, it's due with your tax return. That's all we need to do. We're going to go through the property tax, the Minnesota Homestead credit really quickly, and then we're going to take a break. So we'll try to be relatively quick. It's going to be a long night. Okay. Anyway, the renter's credit got changed. It got broken out. It's added to the regular return. The Homestead credit, they changed their name, but basically that was about the only thing that changed on it. Eligibility didn't change. The process didn't change. The calculation didn't change. So the same things that we used to do if you were here last year or the year before, we still do those again, right? You still have to have been in Minnesota for at least 183 days. You still have to rent, own, occupy, maintain an abode. You cannot be a dependent. And you have to do some more math here as well. When you do the property tax refund, so this is a refund for somebody that is receiving a statement of property taxes payable. Generally, that's going to be somebody that owns a house or a condo. However, some co-op housing associations treat all of their co-op members as owners. And so they will get property tax statements. It's not a large number of them, but there are a few that are kind of floating around out there. When you do the property tax or the homestead credit, you have to determine your household income, which adds back in non-taxable income such as treaty exempt income, scholarships, and other things. So we have that same worksheet that we do before where we do our income and our expenses because that still applies. But then we have to also look at what are all of the different types of non-taxable income you might have received. That can be things that are on your federal return, like a treaty exempt income or a scholarship, even though a qualified scholarship would not be on your return. A qualified scholarship for tuition, that certainly counts. Same thing for tuition waivers or fee waivers. Bank interest, right? Not taxable, not reportable for non-residents, but reportable for property tax purposes. If they have any investment income on the Schedule NEC, that also needs to get added in as well. So there are some additional extra steps that go through to make sure that that form is filled out properly. Again, we have little worksheets. There are worksheet copies of this online as well. Make sure if you're helping somebody with that, have they done this? Write it all out, keep a copy. That way, if the Minnesota Department of Revenue ever sends a letter, they've got that and they can go back to it and say, oh, well, this is kind of how we determined what I was able to do or not. All right. Okay. I will say that the student account is one of the primary resources for filling this out, right? If we're looking to try to understand what tuition payments did you make, what tuition charges did you have, what scholarships did you see, what fee waivers did you have, your one-stop student account is a really good place to see that. So it shows all of that information. When you do that, make sure you look at full calendar year 2025, January 1st through December 31st, not based on semester. It's only based on the calendar year, just like any other tax stuff is. All right. This is an example of, this one's, I think, a modified version, but this was once upon a time somebody's real student account statement. It shows all of the different kinds of charges that they have, right? All of these student fees, all of this other stuff, all of the tuition that gets charged. Sometimes they say, oh, we're going to charge you resident tuition. No, we're going to charge you non-resident tuition. They back things out, right? Some of these can be a little bit of a mess sometimes. But the other thing it really shows are payments, right? Payments made by the individual. It shows payments made by the university, right? They do tuition benefits, tuition waivers, fee adjustments, all those kinds of things. Those are all qualified scholarships. right? So when you look at a one-stop account, look at the charges, look at how all of those were paid for to find out what you would need to report as non-taxable income on property tax or homestead credit, pardon me. This is what the form looks like. The big one, line 6, non-taxable income. There's 3 lines. You could add in like, oh, treaty exempt income, scholarships, whatever the explanation for it is. Here's the huge list of things that might qualify. And our 2 big ones are the scholarships and the treaty exempt income. More stuff. The other thing to know, this is a separate form. So it goes into a different address if you're mailing it in, but it's also just kind of filed as like a separate form. And it's actually not due officially until August 15th. That also means that the money does not come back until about August 15th as well. All right. And with that, whoosh, we're going to take a break. It is 6:40 roughly. So let us reconnect here at 6:45 p.m. So I'm going to stop the share. I'm going to pause. Resuming the recording, resuming the share. Here we go. Okay. All right. So next we're going to do an FSA software demo. So we're going to show you how to get to the real software. I'm going to show you what it looks like on the real software. You all are welcome to do your own returns in the software if you meet the criteria. It's out there, it's free. If you don't have a qualifying email, make sure you email me and we'll set you up so you can still have access. All right, so I am going to do Nick, right? We all remember Nick. Student from South Korea, came here on August 30th, 2023, went home for the summer 2024. All right, 8-1-2024. All right, these were his days. Had not done any work before. Student of accounting at App State University. There's all of his information. All right, he's got the W-2, $7,800. Got a 1042S for 2,000. And let's go. Okay, so if you go out, there we go, to the North website, General North website, you can request a membership here, request a general membership, or request your school's membership, whichever one you want. Once you are a member, you can go here, click on your plans, and access them. All right. Then we're going to go here. So this is all kinds of good information for students. Learn about their taxes, like tax overview, get ready, all about our income documents. Then we're going to go to do your taxes. This is where their copies of the personalized guides are. We do ask all of our volunteers to use the link that is in the Moodle training. The reason why is that we've got a little token on this link so that we can see how many times people are creating personalized guides. Not only for the training, because it's helpful to see how many times you guys do that, but mostly so that we can see like how much are the clients using the personalized guide. So it's just very helpful information to know, is this a tool that is being utilized or are there some challenges there? But then also right here is the software link. This is the real software. So theoretically, I could file a return if I wanted to right now, but I'm not going to do that. I am going to endeavor to log in. All right. And it will send me a code. Go. All right. And here we go. All right. So this is obviously, I've done something in there. So it's saying to continue. Congratulations, your account has been created. We are not going to upload last year's return. We don't need to do that. And we're going to just go enter the information. You can see, right, this looks sort of like the regular TaxSlayer that you have. But it's a little bit different. I'm entering a fake social security number 000 until 05 so that we can't possibly file a return for anybody because that would be very bad. All right. Mailing address, we'll say 20 Home Way. I know that that's not the right place. Oh, it writes 456 28608. Yep, Boone, North Carolina. Elkstone Hall, 70 Locust Street, I think it is, something like that. I am a part-year resident of this state. We're always going to say that because you have you have to answer something, so we're going to pick that one. None of these things work. Oh, he is over 18, full-time student, nothing else. All right, if they wanted to get communications in something other than English, he could fix a different language if he wanted that, but we're going to not do that for now. We're going to select non-resident alien, single non-resident alien. We don't have any dependents. We don't have an identity protection pin, right? Here we go. Is this all look good? Yes, and we go. Hey, we would love to send you offers and charge you extra money, or we can just say, no, we'll not do that. Remind me later. All right. And so that was kind of the introductory bit. So this is kind of the first start. We would say, okay, now we're ready to go. You can see that they've got a little bit of functionality here that we don't see in the TaxSlayer practice lab, right? They've got this nice little, hey, add forms if you want. We're going to say, I don't know which forms, because that's going to let us go into kind of entering everything on our own. And so here's what their kind of general menu looks like. Just like when we have it in TaxSlayer Practice Lab, it looks very similar here. They've changed the format of things around a little bit. The basic information is all over here on the left now. So we would go to the left, 1040 NR Schedule OI. We would enter all of our information. So, right, we would say that we're an individual. We have to do Korea. Oof, that's not gonna work. Let's go back. Let's go down this way. Korea South. Scrolling. Korea. All right. They're not listed. Type of visa is a non-immigrant. F1 visa. No green card, no citizen. Never had a green card. Never changed the visa type. Days 365, 275, 124. Never filed a tax return before. None of this stuff. Not sending a check somewhere else in the world. This is our magic subtract the income box. We're not going to use that for Nick, but that's where that box lives, if you remember, when we have to make that adjustment. Now we're going to enter the first date that he was here in the United States in 2025, and then any dates that he departed or came back, just the one for him. If we had any more, we would enter those here. We just did the little plus, we would enter them. If we need to change something, we can edit it or we can delete it. So, and that's the way the format of the menus work on all of the things. Let's go ahead. I'm going to kind of do things a little bit out of order just to be a little quicker. So we know that Nick has a treaty benefit for wages. So we're going to go here and we're going to say 21, studying and training compensation during training. That is the right one to put. 0 months because he's never filed before. Amount of exempt income, $2,000. Continue. All right, there we go. Let's enter some additional personal information. Let's go do Nick's Form 8843, which is down here again under those miscellaneous forms. Where are you? It's at the top. So it is. There we are. All right. date that he entered the US. This is that date that shows up on line 1A of the 8843, which is 08/01/2024. Current non-immigrant status, that is line 1B. Country of your citizenship, country that's issued you a passport. Those are the same. Eventually we will get there. Down at the very bottom, line 4B, 365, days that he can exclude from the substantial presence test, right? The very, very important one. Appalachian State University. I am sorry, I don't remember what the phone number is. And I know it is at 263 Locust Street, something Clemens Student Union. But I don't remember the names off the top of my head there. All right, we know it is Karen. Karen is a real person. She is the actual person at App State. We're gonna make that up again. Most of the ones that we do, the examples that we're using, when I give you a person's name and the address and the phone number, that is the real name and address and phone number for one of our partner universities. So just so you know, you may see those names again on a tax return, and we do that on purpose so that it looks a little bit familiar. All right, Nick came here in 2023. So yes, he had a visa. It was an F1 visa. Click. No, he didn't change it. Yes, he had a visa during 2024, F1 visa. Did not change it. There we go. All right, that is the form 8843. Now we're going to do, not that, Maria, miscellaneous forms. We want payments and estimates, which is where the 1042S is buried. Where do we go? Foreign person's U.S. income subject to withholding. It's going to be chapter 3. We have to enter this unique identifier. The exemption code for Nick is going to be 4, exempt under a tax treaty. Not amended, nothing. Nope, income code is 20, compensation during studying and training. So that matches up, right? Treaty income or the treaty exemption, we said compensation wages during studying and training. Now we're doing income code 20, compensation during training. There can be treaty benefits, scholarships, or income code for scholarships. So $2,000 of income. And then all of these others are not mandatory, so we can skip over them to say the recipient is code 16. They are an individual, right? Nick is a person. Nick is not a corporation or a partnership or any other kind of entity. All right, let's do Nick's W-2, which, once again, I can't remember the numbers for the EIN, so we'll make it up. Huh. All right, boom, North Carolina. There we are. Wages, so Nick had $7,800 of wages. Anybody remember how much tax he had withheld? 780? Perfect, thank you. I should have remembered that. That's a very easy 10%. All right, and then we go down here, scroll all the way down to do state information, very important. So we're gonna do state. Let's find, there's North Carolina. A pretend state ID number. What was his 417? There we go. 417. There we go. All right. So I've done his personal information is Schedule OI, his 8843. I've entered his 1042S. I've entered his W-2. I've claimed his treaty exemption for his wages. that should be, I think, all of his federal information that we need to put in. Anybody think of anything else that I'm missing? I don't think I'm missing anything, but just in case. All right. Let's go do his state return. All right. So because we said part year, it's going to say, all right, let's figure out what state you need to do. State returns are free. All right. North Carolina, where are you? Ah, there you are. All right. You can select it from the list or you can click on it on the state if you know where it is. All right. What do we think Nick should be? What is his North Carolina residency? Does anybody remember? North Carolina uses the 183-day rule. Anybody want to give me a chat or you can say it here? So he will be a resident of North Carolina, right? Because you'll be a resident if you have spent more than 183 days in there, right? So he is going to be a resident for North Carolina purposes. Sort of, they're not entirely bad on their description of what they're putting there. All right. Okay. Loading North Carolina returns. We need to put the country or the county, pardon me, holy cow. What county was he in? Students can look that up based on their address. So for Nick, it's going to be Watauga is the county. And there we go. All right. We will say yes, so you can look at what this looks like. But generally, because he's a resident, right, all of that information is going to flow through nicely and evenly for us. We don't really need to put anything else in here. If we would, that would be where it would go. If we had to make an adjustment for scholarship income, that would go down into, I'm going to get it wrong. I think it is there, additions to income. There should be an other income somewhere, and there is not. So I am obviously doing a terrible job of giving you an example, and we will find that somewhere else. All right. Yep, I don't remember where it is at this point. So actually, I know why. It's because he's a resident and I can't make the adjustment. So it doesn't even give me the menu option to do that anymore. That is why it's not showing up there. TaxSlayer is more smart than Maria, which is obviously a very easy thing to do today. All right. North Carolina is done. Federal is done. North Carolina is done. Hypothetically, he might be done. So if Nick came into us at this point in our tax clinic, we would be super excited. We'd say, yay, Nick, it's really great to see you. That federal refund number looks to be the right kind of number that we would expect. What we want him to do now is print his results. Because if you think about it, right, how many different places could you possibly click through if you were trying to check to make sure that he clicked everywhere correctly, right? Hundreds of places that he could click. What we really want him to do is get a PDF copy of his return so that we can see it, and then we can go through and quality review that PDF return with his income documents, right? We'll start at the back with the 8843, check to make sure everything is good there, go to the Schedule OI, go to the Schedule A, and then walk through the 1040. Then we'll jump over to his North Carolina return, look at that as well, make sure everything looks good. So, all right. Any questions? I know that was a relatively quick run through. You are very welcome to go out to TaxSlayer to create an account to use the software to file your own return. I'm going to strongly encourage you not to do it, to just mess around with it, just because like it really is the live software. If you really want to do that, you need to enter a social security number that is like 0000000. I did 05. The reason why is that will not let you file a return. That's not a real Social Security number. If you put in, 321-578-4239, that might file. That could be somebody's return that you just submitted on their behalf, right? Which would be sending them to the equivalent of the LITC, or they would be waiting, most likely, 6 to 12 months for their refund, because the IRS systems are very slow to fix problems like that. So it's out there, use it for yourself. I won't recommend that you play with it though, just because of the potential for causing a problem. All right, and with that, we are going to exit out of here. Make that, there we go, log out. Goodbye. There we are. Okay. And we're back to here. Back to there. Back to here. All right. Does anybody have any questions about TaxSlayer FSA before we go any further? All right. Let's keep going then. Oosh, okay. All right. It's gonna be late. Okay. Okay, so hypothetically, the only thing that we have left are 7 more states. I'm not going to do 7 more states tonight. That's way too much. I think we would all be brain dead. So I'm going to talk about Maryland. I'm going to talk about New York. I'd like to talk about Utah. Probably after that, I'm going to let them go and not talk about the other states so that we are done at a decent time tonight. The information is here in the slides. The presentation is already posted. So the information will be out there for you, but we won't spend a huge amount of time talking about it unless you have questions about any one of them, and then we can spend more time on it. Okay. So another comment on the state. So I am behind in giving you all your other states. I prioritize kind of basic tax training over building the Moodle assignments. You can see that they're all live out there. The sections are all up there. Most of them are pretty close to ready to go. So I will be releasing the big ones, Maryland, New York, and Pennsylvania here. I'm not going to do it tonight. I'll do it tomorrow. And then some of the other additional states as well. And then we'll fill out the rest of the not very big, not a lot of people ones like Alabama and Arkansas. Those will come maybe even early next week after 2025 personalized guide goes live. One thing to note though, as we do this, so we've got a set of states that do no state income tax. There are also another set of states that don't honor state tax treaties, right? And then this is where that list of a bunch of them that we do is, right? Alabama, Arkansas, California, also Connecticut, Hawaii, Kansas is one we do, Kentucky, Maryland, Mississippi, Montana, New Jersey, North Dakota, and Pennsylvania. So we're almost at half of the states that don't do that. For whatever it's worth, those are the ones that when we do our reporting, we need to keep an eye out. Hey, am I making sure that all of that income is getting reported as taxable when I file? All right, we're gonna do that. We're gonna do that. Let's talk about Maryland. Okay. Before we talk about that, so all of these states, right? The way that I would describe it is states are a little bit like countries, right? Everybody has something special. They all have something just like a little bit unique and different about that. So that's one of the fun things that I like, but it's also one of the things that can make it challenging to remember, like, which is the one that does this, which is the one that does that. So there will be a shortcut version of these slides. So the 4011, there's the 4011 that's out on the website right now. There'll be printed copies for in-person clinics. There is also in the 4011 that'll be out there. The 2024 version is out there now. There is a state supplemental guide in that 4011 that goes through some of that basic, hey, this is how we do residency. hey, this is whether they do tax treaties or they don't do tax treaties. Here's a few other things that you really need to know as you're trying to do a tax return for Maryland or New York or Pennsylvania or wherever it might be. So the slides are a really good resource for you now. The 4011s will also be out there as well. Both of those are going to be available if you're doing remote events, right? Those slides are out there all the time, so they're easy enough for you to pull up and look at. Okay, let's talk about Maryland, because Maryland's fun thing is in their residency determination, or one of their fun things. All right, so you are a full year resident of Maryland if your permanent home is or was in Maryland, so your domicile is in Maryland, or your permanent home is outside of Maryland, but you maintained a place of abode, a place to live in Maryland for more than 6 months of the tax year. If this applies to you and you are physically present in the state for 183 days or more, you must file a full year resident return. I love Maryland for this because it's so obscure, right? So for more than 6 months. So does that mean duration 6 months? Does that mean any part of any 6 calendar months, like one day of 7 calendar months would do it? It's not really defined, and they don't really define an abode beyond a place to live, right? Could that be a house? Could it be a hotel room? Could it be the corner of a park? Could be anywhere, right? Those are all places that you could live. When we look at a part year resident, that's going to basically be you establish domicile or you abandon domicile. We're not going to have to worry about that. What we're going to use in our guides, and what I'm going to encourage all of you to use is, as far as a place to live goes, anything counts. Like, so you were there, house, apartment, hotel, car, whatever counts. If you go through the days and count up the shortest months, the least number of days to have 6 months is 183. If you go through and count up only the longest months, the least number of days to have that is 186. So if you are present in Maryland for less than or equal to 182 days, you must be a non-resident. There's no way you can't meet that 6 month or more than 6 month requirement. If you're present for 187 or more, you must be a resident because you were physically present for 183 and you were present for more than 6 months, or at least during part of more than 6 months. In between that 183 to 186, count the number of months that you've been present. If it's greater than 6, you're a resident. If it somehow turns out to be less than 6, you're a non-resident. The reality is, most of the time, it's really pretty easy. If they came for the first time in the fall semester, that's only 4 months, they're going to be a non-resident. Once they're there for a spring semester and a fall semester, that's way more than 183 days. That's way more than 6 months. They're going to be a resident. All right. For Maryland tax rules, so you use the same filing status as on your federal return, single or married filing separately. They have this special dependent taxpayer status, which affects people that can be claimed as a dependent. Might affect some resident clients, but it's not going to affect any of our non-residents, right? They're going to generally have parents that are living in another country, not filing a US tax return and claiming them as dependents. Everybody can claim the standard deduction or itemized, kind of independent of what's going on with the federal, which is super nice. For both Maryland residents and non-residents, if your income is below, should be the standard deduction, your Maryland tax is 0 and you're not even required to file a tax return, which that single or married filing separate number is that 15,750. You can still file to claim a refund if you've had some tax withheld. And there are some special instructions. You only have to fill out parts of the return form. You don't have to fill out the entire thing. So not everybody has to file a Maryland return if they file a federal return. However, it doesn't hurt anything to file it. So if you went ahead and file it and you didn't need to, it'd be like, oh, okay, like I had $10,000 of income and I owe 0 tax. Done, right? There's nothing bad that happens with that. So if somebody files when they didn't have to, it's not a problem. One other special thing about Maryland is that they have a local tax. The good news is that it's collected on the state tax return, so there aren't any additional forms that you have to fill out. You just have to enter some information to identify what that local tax jurisdiction is. Local tax only applies to Maryland residents, and you have to enter a Maryland address if you're a Maryland resident. And then you select the county when you're preparing the returns. Because they didn't want to let them not have to pay anything, I think, non-residents have a special non-resident tax. So you don't have a local tax, you get a non-resident tax, which is basically like, you don't live here, but we still want you to have to pay for all of this stuff as well. Special tax rate, that's how that goes. All right, Maryland does not honor tax treaties. If you are married and you're from Canada, Mexico, South Korea, or a student of India, you might be able to claim an exemption for your spouse on your Maryland return. If you're from South Korea, the spouse must have lived with the taxpayer here in the US at some point during the year. For the others, they must have no gross income and not be able to be claimed as a dependent on another person's tax return. Maryland has reciprocity with these other states, DC, Pennsylvania, Virginia, and West Virginia. Remember, Pennsylvania, we said basically everybody's going to be a non-resident. So it's theoretically possible that somebody could be a resident in Maryland and went to work in Pennsylvania and then came back. And so they would use the reciprocity rules where they would only pay Maryland tax on all of their income. I don't know that we'll see very many of those, but it's a possibility. It's out there. I'm going to make you aware of it just in case it happens. If something like that happens, hopefully they've done the proper paperwork with their employer. And so their employer knows about this and they only took out Maryland taxes, even though they were working in Pennsylvania or Virginia or West Virginia or wherever. All right. Maryland does have a low income tax credit or an earned income tax credit, just like the federal tax returns, the federal credit, but non-resident aliens are not eligible for this. If you are a resident alien, you could be eligible for this if you would have claimed if you did actually claim the earned income tax credit on your federal return, or if you could have claimed it except that you only had an ITIN instead of a social security or a social security number. So basically, if you didn't get the earned income credit on the federal return because you're a non-resident, you don't get Maryland's. If you didn't get the earned income credit on the federal return because you don't have a social security number, then you could get that credit from Maryland. They also do have like an online direct e-file system they call iFile. So a Maryland resident probably won't be able to electronically file their state tax with TaxSlayer because the state tax is going to want to say, hey, what is your spouse's name and information? And you can't enter that on the federal return, and so it will bug out and make them paper file. This happens in almost all of the states that we support for married non-resident aliens. However, the Maryland Office of the Comptroller has an online tax system where they can file electronically that Maryland-only tax return as well. So that's an alternative for them to do. It looks like generally in Maryland, if you get things entered, mostly it flows through pretty well. The icing on the top of this fabulous Maryland cake is that our big partner in Maryland, the University of Maryland, Baltimore County, has a unique way of reporting income on their documents. So they've done this, I think, in part because Maryland does not honor tax treaties. So let's imagine a student from China. They have $5,000 of treaty exempt wages on a 1042 S Code 20. They had a $7,000 taxable scholarship, or would have normally been a taxable scholarship, on 1042 S Code 16. So like stipend, something like that. And then they had $9,000 of wages. This is what their W-2 would look like. It would show the $9,000 of wages up in box 1, tax withheld in box 2. But down at the bottom in the Maryland section, it will show $21,000 of wages, even though it's not wages. It's wages, but also treaty exempt wages, but also taxable scholarship. This is how they handle reporting that income having some state tax withheld on it. This can sometimes also cause problems as well, particularly when their state income tax is higher. If they've had more income tax withheld than their total wage income, here in box number 1, TaxSlayer is not happy with trying to file a return like that. And so that's where they're going to probably have to paper file in that situation. Okay? All right. Any questions on Maryland? All right. Let's move on. We'll do New York. We'll go through Utah really quick, and then we'll call it for the night. Okay. New York. New York. I love New York because they also have fun stuff, but their fun stuff is easy for us, and that's the best kind of fun stuff. Okay. Residents for New York. If you are domiciled in New York, you are a resident of New York. That's great. If you maintain a permanent place of abode in New York for substantially all of the tax year and spend at least 184 days or more in New York State, you are also a resident. New York has defined substantially all as greater than 10 months. So, physically present for 184 days, rent, own, occupy, maintain an abode for more than 10 months out of the year, which is a pretty big, very doable, but pretty big layer to meet. But there is a fabulous exception to this, which is undergraduate students are automatically non-residents of New York, independent of their federal tax residency status. They are automatically a non-resident of New York. So that means that mostly all of our people that we're going to help from New York are going to be non-residents. Yep, there can be a few that are not undergraduate students, but most of them are going to be non-residents. So that makes that pretty darn easy. All right. New York honors treaties, which is really great. We love that. If you are a resident and you have to file a federal return, you need to file a New York return. If you are a non-resident and you have New York source income that's greater than the New York standard deduction, you need to file a New York return. And that New York standard deduction is $8,000. Again, right, if you file a return and you don't need to, it's not a problem. You just tell them, hey, this is my income. I don't have to pay you any money. They're like, fine, whatever, next. So it's not a problem. And whenever there's a question, we always say, sure, go ahead and file that New York return. There is a city tax for residents of New York City and Yonkers. Otherwise, there is no city or local tax. We don't have any partners in either of those areas. So probably you won't see any New York City or Yonkers tax. Otherwise, it's on the state form. It's relatively straightforward. It's not a big deal. On the New York form, you have to report your permanent address if it's not the New York address. So it'll be people's home address in their home country, whatever that is. They're going to use the same filing status as on their federal tax return. Scholarships and adjustments. So when we do scholarships and adjustments to report taxable income or not taxable income, there will be some adjustments that you might have to do on a New York return as well. The reason for that is that for New York taxes, qualified education expenses do not include books and equipment. So if somebody had a qualified scholarship, but of that $500 was for books, for example, then they would need to add back in $500 of scholarship income onto their New York tax return to report that as taxable income. Non-residents have to report their living quarters. I love it. I love their words. Living quarters maintained in New York, which is basically the address, wherever you were, the address, and then the total number of days that you were in New York. And for New York, any part of a day counts. It gets reported on this IT 203B. Schedule B is where it goes. New York has this super cool college tuition credit or itemized deduction. So for eligibility, New York residents are the only ones that are eligible for the credit, but both New York residents and non-residents are eligible for the deduction. So it's kind of like an itemized deduction. You cannot be claimed as a dependent on another return, which is great. You don't have to be enrolled in a degree program or attend full-time, although most of our clients will be. Couple of important things to note, right? This only applies for undergraduate tuition, so it doesn't apply to graduate tuition, and you can't use any room and board, books, or fees like that. The credit itself is worth $400, but the deduction is worth $10,000. So if somebody is a New York, even a New York non-resident, and they're paying tuition, they can potentially get a really big additional deduction of how much income they have to pay tax on in New York. So that is a super cool, super fun thing that they've got. All right. Any questions on New York?
I have a question.
Yeah.
For residency, is there any special treatment for graduate students?
In terms of whether they're residents or not?
Do they just have to go by the regular rules?
They use that 184 days greater than 10 months.
Okay.
Is what they use.
Okay.
So, which it's very possible that they will be, but it would just depend on that.
Okay.
So,
thank you.
Yeah, of course. I was looking to see if Linda was online, if there was anything else she wanted to add. Or not. It's quite all right. You can tell me later over email if I messed anything up. All right. We're going to do this. We're going to make that small. Okay. All right. We're going to talk about Utah. Let's talk about Utah. All right. Let's make that small. Here we go. Okay. All right. Utah residency. So Utah domicile is determined by two main tests. So their tax residency or domicile is the way they look at it. So there's an automatic domicile test. You are automatically domiciled in Utah if you or your spouse meet any of these criteria. If a dependent for whom you claim the child tax credit on your federal return is enrolled in a Utah K-12 public school, if you are enrolled as a resident student at a Utah higher state education institution, or you voted in Utah and you haven't registered to vote anywhere else. Of those three, hypothetically, we might have somebody that meets the first one, right? We might have, I'm going to imagine a PhD student from South Korea. They came to the US, they had a child, so that child is a resident. They can claim them on their tax return. That child has started kindergarten. They might meet that case, right? That is a 1 in 5,000, 10,000 kind of a chance, but it's theoretically possible. The voting definitely shouldn't happen. They shouldn't be enrolled as a resident student at all. They're non-resident. So probably quite unlikely that the automatic domicile test will apply. Test number 2, intent and permanent home. So even if you don't meet test 1, you can still be domiciled in Utah if you have a permanent home in Utah to which either of you intend to return to after being absent. You have voluntarily settled in Utah, not for a special or temporary purpose, but with the intent of making it your permanent home. All right. This intent has got like a huge list of 15 factors. You have to have a preponderance of them, which include things like driver's license and locations and how long you're there and all of that. But if we come back to those number 1 and in particular number 2, right? So remember, we're helping international students on F&J visas. So they are here for a temporary purpose. They are here to go to school. They're here to teach. They're here to do research, right? And their time in the US has an end date, right? Unfortunately, they have to go when their visas expire. So they have no intent of making it a permanent home, right? That visa is issued under condition of them not having a permanent home here and leaving. If their visa status changes and they go to an H-1B or they get a green card, then of course that changes, right? They're going to be here. But for now, they can't have an intent of making a permanent home. So basically this means that, again, barring that 1 in 5 or 10,000 individual, almost all of our students that we're going to help are going to be Utah non-residents, which makes life a little bit easier for us. There is a fabulous spousal rule. Basically, if one spouse is domiciled in Utah, then the other spouse is as well. There's some cases, like you can prove that you weren't if you haven't been there, like you're separated, all that kind of stuff. But anyway, Utah residency has the same kinds of effects on taxes, just like a lot of the other states, right? If you are a Utah resident, just like North Carolina or Minnesota, you're going to pay tax on all of your U.S. income. If you are a non-resident, you're going to only pay Utah tax on U.S. source income. Ignore that slide. What am I doing? All right. You have to file a Utah tax return if you are a resident or part-year resident, and you have to file a federal return. But if you are a non-resident, you have to file a return if you have income from Utah sources. So basically, this is going to say if you have income from Utah, pardon me, you're going to need to file a Utah return. You're also going to file if you want to, you don't have to, just to get a refund of any taxes that were paid. All right. Utah does honor federal tax treaties, which is fabulous. We always love that. And this is the special thing about Utah. I quite love this. Every time until I understood and learned about Utah, I would always say, married is married. I don't care where your spouse is. If you are married in your home country, you are married here. And that is true, except in Utah, where if you are married and you are in Utah and you are a non-resident, you are still going to use the filing status of single on your Utah return. Everything else is going to be married filing separate, but you're going to file as single. If you met qualifying surviving spouse criteria, you would use that. But that is the 1 in 100,000, not the 1 in 5 or 10,000. So that is one very unique thing that they have in Utah. You're going to use on your Utah tax return, you're going to use your federal itemized or standard deduction amount, whatever it was. For itemized, you're going to subtract any state income tax that was included in your itemized deduction. So most likely that means you're going to have no itemized deductions unless you had a charitable contribution, but standard deduction amounts still apply for treaty people. They also have personal exemptions for dependents, right? So even though those don't exist on a federal perspective where you get money off on your taxes based on people, that does exist for Utah. And there is a bonus for the year that the child is born. You basically get a double bonus. So $4,222 reduction in income that you have to pay tax on rather than just the $2,111. All right. And with that, we're at Iowa, which I'm going to skip over. We're going to skip Iowa. Yes, that's a little complicated. We're going to skip Alabama. We're going to skip Arkansas. All right. Let's talk about, where are we at? We're almost done. Almost done. Good Lord, Arkansas. Yes. Okay. Okay. So rest of tonight, there's not really much rest of tonight. Your challenge for this week and then next week, right? So your goal should be catch up on Moodle, right? If you're already caught up and you're saying, Maria, where are my other states? Well done. Thank you. I will get them to you as quickly as I can. For everybody else, work your way through it, right? Do Do Nick, do Harold, do Sergio, do Kim, do Elena, do everybody. Next week, we're going to have a brief presentation to start with from the NRV TAP leadership team for leadership opportunities. So that's the University of Minnesota student group that helps organize and facilitate the clinics here on the U of M's campus. We're going to talk about clinic process review, what to expect. We're going to talk a little bit about current environment, what we're doing in response to that as well. Then we're going to talk about the final readiness check. Why are we doing this? What are the goals? What exactly do you need to do? When does it need to be done? There'll be time to work on this during the event. So next week's session is, I would say, light on content. It's going to be much more about process and information, final kind of getting ready for things. This is the last of like the heavy duty content in terms of tax knowledge that we're going to talk about. And celebrate the training, right? So next week is the official end of all of the sessions. So we still have a little bit of work in Moodle that we need to do. And then we're gonna start helping people, right? The emails are already coming in. The appointments are starting to get booked. So I know that people are excited to get help, and I am really excited to start being able to help them. And with that, that is everything for tonight. Thank you all so much. If you have any questions, I will be happy to stick around for a few minutes. I see that there is a chat. Linda says, no worries. Thank you, Linda. That is awesome. I completely relied on all of your great guidance for that. So thank you, everyone. Have a wonderful evening, and I will see you in Moodle.